Real Estate Ninja here. I hope you're doing well. Got a lot of news to go over with you. This is why you have been preparing. This is why people should be preparing for an epic collapse in our markets. I've got 3 or 4 stories to go over with you. Just understand this. All of this crash news, all this bad stuff that's happening, this is exciting. This should be exciting for you because once you realize it and you start to do something about it, you start to save money and get ready for it, you are going to level up in a way that you've never leveled up before, especially in the real estate markets. The real estate markets are going to get hammered. They already are getting hammered in transactional volume, in price drops. I'm telling you right now, there is epic opportunities everywhere. As businesses close, you will make more money than I ever made during the Great Recession. And I was selling my houses in 2006 to get ready for it, and I made great money. People don't understand that. And if you position yourself ahead of time, you're going to crush it. With that being said, I put some more discount links, 80% off for the real estate crash course, how you can prepare for that right now. It covers all kinds of facets of your finances, but also real estate cycles. You need to learn these cycles. So if they're not $199 and they're not 80% off, but also there's a special offer coming to everyone that's in that course coming in the end of November. All right. Okay. First story out of Zero Hedge. .com bubble redo. Charles Schwab begins layoffs amid a challenging year. Now, we've already seen lots of bank layoffs. We've seen some layoffs in investment banking. This is a pretty good sign. It says here, Charles Schwab, the latest publicly traded U.S. brokerage firm, began laying off employees on Monday in an effort to streamline its business model by reducing expenses ahead of next year, which could be full of turbulence in financial markets. This comes as the market's excitement in meme stocks, SPACs, IPOs, and crypto, which soared in 2020-21, has since plunged due to a rising interest rate environment. I want to also make sure everybody understands this. The FOMO that is put into markets when asset prices increase, still to this day, it always blows my mind. But one thing that's very important that people need to understand is when these little bubbles pop, it goes from euphoria and excitement and all this chatter over the internet to silence. And it causes a lot of people to run in fear and sell. One of those aspects of excitement have honestly been the higher treasury yields, because there's a certain subsect of individuals or investors that are excited about getting 5%, 5.5% in short-term treasuries, so short-term bonds. And what they don't realize is the effects of those higher yields, what they're having on the real estate market and other markets, like in industry. All right, one of the stories are going to talk about that as well, and that leads to a catastrophe for everyone. So we're already seeing these little deflationary spikes, and it's going to get worse. And when you see layoffs, and I warned about these layoffs coming a year ago, and saying specifically in October you're going to see these ramp up, and just like this story is saying, they just started. Charles Schwab just started these layoffs this last Monday. And they're expecting turbulence in the financial markets, just like I've been warning about in 2024. And I'm not talking turbulence. I'm talking about bad stuff. The Wall Street Journal first revealed the Schwab layoffs on Monday night. Charles Schwab on Monday began laying off employees across the company. Schwab, the largest publicly traded U.S. brokerage, didn't disclose how many employees were affected in an internal message seen by the Wall Street Journal. Some remaining employees will have new jobs or managers, according to the message. Just so you know, that's a CYA for them, because they don't want to cause complete panic in their workforce, and people that they did not want to let go just quit because they found a new job. So what they're doing is they're trying to hold back the numbers to keep as many people as they can as they're laying off the people that they want to lay off. It's a little trick from a C-suite exec. All right. In the message, CEO Walt Bettlinger and President Rick Wurster said, "We know this has been a challenging year and that today was hard. We also know the work needed to come through this challenge. Through this change, even stronger than before, is just beginning. Perhaps trouble at Schwab comes as retail traders badly bruised from holding worthless meme stocks lost interest in financial markets this year. I can't get over how much hate I took when I came out and says people I warned about the AMC trade almost a year ago. It was like a year ago. That stock is now down 98% since I came out with that video. And so many people just were cursing at me and yelling at me. You got to go back and look at that video. It was back like last October and November where I said, beware of the AMC stock because they're going to dilute the heck out of it. Everything I said in that video came true. We were planning on doing an edited video of it and what's going on with it now. But that's just one example of so many stocks that have been just beaten down, and people like find this weird cult-like following, and they don't realize that it was started by hedge funds, and they bought the shares at pennies, started this campaign, and then they sold it to you for dollars. It's very sad to see people get taken advantage of of this, but it's just how the world works. It says besides retail's waning interest in markets, the company has been under scrutiny from shareholders about deposit flight driven by higher interest rates. Schwab shares are down 40% since peaking at the 84 handle in March of 2021. And remember what I say about peaking share prices as they come down, companies find it harder to borrow money. So it's very important to understand. Also, real quick, this is not the Economic Ninja channel. It's Real Estate Ninja. If you wouldn't mind hitting the subscribe button, hit the bell icon. Really appreciate it. I'm going to be sharing all kinds of videos. All of them are original. They're not the same as the Economic Ninja channel. Let me dive into the next story. Conference board confidence weakens again in October. Inflation expectations jump. Now, what is this? Why is this important? There are so many different surveys out there to rate the health or the sickness of an economy. And one of those is a polling of people that belong to conference boards. And they are very integral in this data gathering process. And the reason why is because they have the pulse of conference boards, companies. You know, what's the rhetoric going, what's going on? What's the language being shared? Is it optimistic? Is it pessimistic? Things like that. So it says here it weakens. This indicator weakens again in October, and inflation expectations jump. It says after reaching 2-year highs in July, the Conference Board Consumer Confidence Survey has fallen for 3 straight months, declining from 104.3, which was revised higher in September, to 102.6 in October. But that was better than the 100.5 expected. Both present situation and expectations also fell, dragging the headline down to its lowest number since May. Dana Peterson, chief economist at the Conference Board, said this: consumers also expressed concern about the political situation and higher interest rates. Worries around war and conflicts also rose amid the recent turmoil in the Middle East. The decline in consumer confidence was evident across households aged 35 and up, and not limited to any one income group. So that's across the board. Everyone's concerned. And you know, as that emotional shift happens in everyone's brains and they go to negative, go to recession, they go into depression, that's when the economy really starts to pick up its downward spiral. Says assessments of the present situation were driven by less optimistic views on the state of business conditions, but consumers' rating of current job availability held steady. Fewer customers said that business conditions were good, and more said they were bad. Regarding the employment situation, slightly fewer consumers said that the jobs were plentiful compared to September, but the number saying jobs were hard to get also declined. However, when asked to assess their current family financial conditions, those responding good rose, and those citing bad were little changed. This suggests consumer finances remain buoyant in the face of elevated inflation. I have to be honest with you. I think that is changing rapidly. And remember, we're dealing with data that's a few months old, okay? Since then, mortgage rates have gone up another point. Credit card defaults have risen more. There's a lot of data points that are showing that things just in the last 8 weeks have deteriorated rapidly. And that's to be expected from an economy that's going into hyperinflation, all right? And not hyperinflation across the board. Now it says expectations for the next 6 months stayed below the recession threshold of 80, reflecting a decline in confidence about future business conditions, job availability, and income. As Peterson noted, the continued skepticism about the future is notable given U.S. consumers, at least through the third quarter of this year, continue to spend heavily on both goods and services. I've said this before, I'll say it again. I believe that is the ramp up to hyperinflation because people are saying, I'm starting to see my dollar is going down in value every month, so I might as well stock up on certain goods. That's why I believe our GDP jumped. Between that and the government spending tons of money on war and borrowing a ton of debt, that's why I believe the GDP went up. Let's go to the next story. Yields spike after employment costs unexpectedly reaccelerate. It says U.S., this is out of Zero Hedge, U.S. employment costs unexpectedly accelerated in the third quarter, heightening concerns that a strong labor market risks keeping inflation above the Fed's target. The Employment Cost Index, a broad gauge of wages and benefits. Remember, I've been talking about how for the last year, you're going to see tons of strikes because employees are going to want higher wages, better benefits, right? To deal with to offset the cost of inflation. Well, this is an exact, this is the evidence, the outcome of that. Employment costs are rising. And it's great how it says unexpectedly reaccelerate. Anyone can see this coming. It's just normal, right? But once you start seeing this coming, you go, okay, well then what's next? And most people are just more surprised. Oh my gosh, it's reaccelerated. I can't believe it. Yeah, like really? Like what school did these people go to? That's what happens when companies strike or employees strike and force companies to pay them more, or employees have to pay more without the employees striking because they're having a hard time getting people, that have the skills necessary to keep the company going. We've seen that in the last couple of years too. So there should be no surprise about this. But what scares me is that people aren't thinking, they're only looking at today and they're shocked about what happened this last quarter. They should be looking at what's coming this next year. And that is a big deal. That's a big deceleration in not only wage growth, but productivity. It says the Employment Cost Index, a broad gauge of wages and benefits, increased 1.1% in the July to September period after rising 1% in the second quarter. That's 10%. Compared with a year earlier, the ECI was up 4.3%, which is the smallest annual advance since the end of 2021. Still, that's well above the typical pace seen in the years before the pandemic. While wage growth picked up slightly within private industry, salaries at state and local governments surged. It says, bear in mind that while there are a number of other earnings metrics published more frequently, including average hourly earnings figures from the monthly jobs report, economists tend to prefer the ECI because it's not distorted by shifts in the composition of employment among occupations or industries. This prompted a spike higher across the yield curve, with the shorter end affected most. So we're seeing rates increasing as well. And why is this? Because the more and more investors get spooked about the economy, the more they are going to demand a higher rate of return if they're going to loan money into the economy. Okay, that's why bond rates are going up. They're going up completely independent of what the Federal Reserve is doing. And this is a very incredible time of decoupling. We have not seen this since right before the 2008 financial crisis. It's been a long time, and it's exciting for me. But it should be exciting for you. And if it isn't, then do something about it. And once you do something, you prepare, you get out of debt, you get less debt, you don't get into new debt, you save money, you buy some inflation hedges, you get really excited about this because then you see the potential of what you've done, your preparations to go and crush it. Look, I'm going to put some more of those 80% off links to the real estate crash course. I got a special announcement, an offer for everybody that's coming at the end of that month, because I've got some really neat things, because this real estate crash is already accelerated enough to where I can put out the next installment of what I'm going to be doing. I hope you have a great day. Thank you so much for watching. Thank you for hitting the subscribe button if you haven't already. And thank you to all of my subscribers. The Real Estate Ninja is out.